All right, guys, welcome back to the channel. This is going to be a continuation video of my stocks that maybe you shouldn't buy for 2020. This was, again, based on a few fundamental principles of valuation. So as we go through the list, I'm not going to do a very deep dive into these, but these are some stocks maybe to throw out there on the chopping block. And if you are already invested in these stocks, good for you. These would be stocks that I would contend maybe don't deserve new starting positions in based on valuation. So let's get started, guys. One of my very favorite companies is Adobe Systems. I do own this stock in the M1 Finance account in the aggressive growth. I did that for a reason. I did want exposure to the company, but I felt like the valuation was extremely rich right here, which it is. And so we own just a little bit in the technology sector in Adobe. It's not really a high growth. It's a very good quality company. But on valuation alone, just like the rest of these names, I feel like it probably needs to come in a little bit before accepting a new position. And I think 275 is probably that target there. The next is Intel. Intel, with a lot of the chips, I feel like I've really run up, and I know it's one of the crowd favorites. I do own the stock, and I'm going to continue to do so and just sit on the dividend yield. But Intel is a little bit slightly overvalued here. The next on the list is going to surprise some people, and unlike my new position in Honeywell, United Technologies has really run up in the portfolio. I'm up about 32% in the name right now. So it's performed really, really well this year for me, but I think United Technologies, if you're going to devote new money to it, I would use some scale and some caution. I like the dividend yield. I love what the company's doing. I will continue to be a shareholder in United Technologies, but at these levels right here, just over 150, I feel like we're bumping up the top end of a range here. And I think United Technologies probably not the best pick in the industrial sector at this point, okay? The next on the list is Wynn Casinos, one of my favorite places in Vegas. I know they own the Macau properties. Really good, premier operator in the space for sure. But on a pure play valuation perspective, not the best place. Casino and gaming is not really one of my favorite places to invest anyway. But Wynn absolutely made the list when we were talking about some overvalue, okay? The next, I'm going to get into a couple of actual brokers. TD Ameritrade right here, if you were looking to buy the underlying stock in TD Ameritrade, if you already own the name, great, that's fine. I own TD Bank, which is actually the owner of TD Ameritrade. Toronto Dominion is actually a Canadian bank, and it actually is a nice 4% yielder. And unlike TD Ameritrade, I think that TD Bank is probably better suited in the financial sector. If nothing else, you sit on the 4% yield, but TD Ameritrade is one of those overweighted right now. Nvidia, another one in the chip space, probably best in breed. Another one that I took a very relatively small position in this year was Nvidia. So one of those ones that you got to be kind of careful with. It's run up so far, so fast that you know, you really do stand a good chance of getting burned out. If you've owned the stock, so be it. If you do have owned the stock throughout this run, I would consider maybe trimming a little bit back, taking some profit off the table and put that profit to work somewhere else for yourself. Weight Watchers. I think a lot of people are going to be looking to jump on the bandwagon with the New Year's resolution, thinking that Weight Watchers is going to pay off. I would be careful. Okay, I think Weight Watchers is extremely overvalued here. I would be careful, and I would look in a different direction if that was your thought process in considering Weight Watchers. The next, just like ETrade, with the same deliberation of TD Ameritrade. ETrade, I think, is probably one of those. It has not jumped on board yet. It was not acquired by Charles Schwab. TD Ameritrade got the nod there. And I think ETrade will suffer for that. I think in a very competitive landscape of no cost entry, ETrade does a great job on their platform. They're a very, very good trading platform. But I think with increased competition and the already increased valuation in ETrade, I would absolutely look elsewhere. There's a ton of different options in financials right now. One of my favorite sectors. It's already run up quite quite healthy. So you got to be very careful and very selective in the financial sector. But ETrade is not one of those places that I would look. Best Buy, okay, we are done with the holiday season, and Best Buy will go into seasonally a low season for them as we move into the winter and the summer. I think Best Buy is probably trading at a little bit too rich of a valuation. I would be careful with justifying holiday profits as a reason to pick up the stock right here. Best Buy does what they do very, very well. As a matter of fact, I would consider them a best-of-breed company in what they do. I just don't know how long. Best Buy has really surprised me in how sustainable they can be in that niche of consumer electronics. But I think there's so many different options out there better suited to outperform in 2020. I think I'd look elsewhere when considering a Best Buy. Wells Fargo has actually performed very well, but in the financial sector, I would be very careful. My main concern with Wells is the continued headwind from the scandal that they went through 4 or 5 years back with the account scandal. It's really still lingering. There is still some questions about how they're running the business. It's a good dividend payer. I hate to say this because I do own the stock. But Wells Fargo is one of those in the financial sector that probably you could find some better value elsewhere in financials. Cisco being, or excuse me, Citigroup being one of those, okay, which is my favorite. The next is John Deere. John Deere has been one of those companies that I've just watched run to the moon. It's one of my favorite companies, but from a valuation perspective, we need to be kind of careful at these levels here at 180, 185 as it lingers there. Snap has been one that's been also fun to watch in 2019, run to the moon, gone from $3 or $4 up to $15. Now everybody wants to jump on the bandwagon. I wouldn't touch this. Be very, very careful with your social media plays. I think even with some of the bigger companies, which I do think Facebook and Google are two of the premier players in the space, absolutely. Cloud computing obviously comes into the mix as well, but I would just be very, very careful with looking at your pure play social media platforms. Twitter is probably a little bit better, but as a user, I just can't get behind the product. I don't really understand what all the hype is about. I'm absolutely on board with the hype surrounding Facebook and Instagram. So if you were going to look to make an investment in the social media space, that would absolutely be where I would look, and I would look somewhere else other than Snap. The next on the list, I really hate to say this because it's one of my favorite in the technology space or the payment space, is Visa. I think the loved company right now is PayPal. I did take a very small position in the aggressive growth portfolio in PayPal, so we just own a couple shares of the stock. I still continue to own Visa, and I'm looking very, very intently at American Express as a value play this year into 2020. Just to give you some idea, I looked at MasterCard. I did not like what I saw. So just to give you an idea, amongst the big three, Visa still continues to be my absolute favorite. But from a valuation perspective, it has run to the moon. It really has. I remember it split a couple years ago at 100. It went down to 50. Now it's flirting with 200 a share back again. So we'll see what happens with Visa, but I would just be very, very careful with entering into Visa at these levels. Lockheed Martin, same idea. I continue to own a small position in Lockheed because I feel like it's the premier player in the defense subsector of industrials. Raytheon, Northrop Grumman, Lockheed Martin, those are my favorites. I like General Dynamics as well. General Dynamics I do not own, but Lockheed Martin is one of those that I really feel is probably not ripe for the picking here. You're going to have to be careful with that one, okay? The next I've already mentioned is MasterCard. It will fall on my list of 2020 of no touches. So I won't be taking a position in MasterCard. I looked at it. I didn't like what I saw. The next is CVS. CVS is a company that I do own. I own a small position relative to the total overall portfolio. It's a good dividend payer and it's a good business, just like Walgreens Boots Alliance, but CVS is one of those that's actually run up quite well. I took some very good trading profit in CVS during 2019. I just don't see it continuing into 2020 as I really feel like CVS is actually right at about fairly valued with where it should be. Bristol-Myers Squibb, same thing. The time to buy Bristol-Myers was at 47, okay? Here at 65, we're talking about a stock that's fairly valued. If you want a good dividend play, I love the business. Bristol-Myers is a great company. It's worth investing in. It's an investable company. But here, fairly valued. If you were lucky to get in, I got in the mid-50s, sold it, bought back, and made money with that trading position as well. But I would just be careful with entering into a new position here with Bristol-Myers Squibb. The next on the list, I'm probably going to take a ton of heat for, but AMD is way overvalued right here by any stretch of the matrix. I understand taking market share from Intel, very well-run company. I like AMD. I've never owned it to make money. Maybe I'm just upset that I missed this big run in AMD. Not really. I don't invest that way. I don't play the what-if game, but I absolutely play the what-if game as far as investing in a company like AMD right here. I would let things pan out a little bit going into 2020, and I think AMD may pan out to be one of those stocks that you don't want to touch. The next one may surprise a lot of people as well. Apple Computers is overvalued, and it's overvalued by a long shot. It went from a PE of 13 all the way up to 24, guys. That is amazing. It has been given all of the nods and all of the considerations on the positive side of the house, where Apple traditionally endures a lot more scrutiny like that. It's probably one of the most common held stocks across the world in most of the pension funds. I've actually reduced my position down twice now in Apple. I think I own a small position, about 6 shares in Apple right here, and I'm comfortable with that. I really am. I think if you are an investor in Apple, it's a great company to continue to hold going forward, but I would be really, really cautious in introducing Apple to the portfolio at these levels as one that I contend that you can buy and own forever. I would just look to be careful at these levels with Apple Computers. The next is another stock that you could have bought and owned forever. If you go back through the catalog of videos, JP Morgan Chase is one of those, but that is also the premier bank that's run up very, very high, and it's been stretched a little bit. So we will see how it happens. It's one of the biggest financial holdings in my portfolio. So I do continue to hold the shares, but for new investors looking at a JP Morgan Chase, if you were going to invest and start a new position in it, I think the real takeaway from this video is if you're still interested in any of these names, you can still invest in them. Just use some scale. Okay, start a little bit of a starting position. That way, if the stock takes a nosedive or corrects back a little bit, you've got the opportunity to average down in the shares. And the final one right here, this is probably the one that I'm going to take the most abuse for. I own about a half a share in this company, which I can sleep easy owning a half a share in Tesla, because I quite frankly can't handle the swings. But you can either be in the camp of the valuation camp that the stock is only worth $275 a share, which it is, or you can be in the camp that it's going to be at $4,000 or $5,000 a share someday. Certainly, anything's possible. I know there's people saying that it's going to $4,000 a share. Why not just say it's going to $10,000 a share? Because I put those two wild guesses for the stock in the same category. I tend to invest with a little bit more discipline than that. I'm excited by the prospects of Tesla 10 years down the line, but I'll continue to just build and establish a position in the company smartly in the aggressive growth portfolio. So guys, I hope you enjoyed this list of 20 stocks that you may not want to invest in for 2020. This will round out the list for going into 2020. Obviously, the disclaimer is very simple. You're going to want to do your own research on these stocks before making your own investment decisions. We do this for entertainment and very, very specifically for awareness to what's available out there in the landscape. I think the more informed we are about researching some of these stocks and becoming aware of some of these super large, very, very well-established businesses out there, the better off we'll be and the more informed decisions we can make, guys. So if I've missed something, leave them in the comments section. I'll appreciate reviewing through the video on that. If you haven't subscribed to the message, hit the subscribe button. Help us support the mission that we're putting through on the Independent Investor channel. And like always, guys, good luck in your investment future.